So the bank reconciliation statement, the books and the bank statement usually show different cash balance. So differences arises because of the time lag in the recording transaction. So two records of the business cash account in the company's ledger and your bank statement. If they shows different balance, then don't worry about that. This is not a case of fraud. Maybe a case of fraud, but usually it shows different balance. Why? Because there may be a time lag. I will see in our coming slide what does it mean. So the differences arise because of a time lag in recording the transaction. Here are some example. We have a bank side, we have a book side. Book side means what we have in our accounting books and what the bank have in their systems. We call this bank side. So why you write a why when you write a check or use your bank debit card, you immediately deduct in your checkbooks, but the bank does not subtract the check from your account until the bank pays the item a few days later, and you immediately add the cash receipts for all your deposits or ETFs credits. But it may take a days or two for the bank to add deposits or credit to your balance. So the differences are, so banking deposits in transit. So you send a check receipt, or you send a check to the bank asking that I am sending you a check, please transfer this amount to my account, and it takes time. But you in the books you automatically say that, okay, customer pay me cash, so you make an entry that account that cash to account receivable. You collect cash, you deduct it from account receivable, right? But bank takes 2 or 3 days to process this. Maybe the cash is bounced, or there is a processing time over there. So that's why there is a difference. So electronic fund transfer, you do it through electronic fund transfer, and you maybe it takes time, or maybe you do it at night, or in the break. It takes time to record it into your book side. And outstanding checks, you write it down and you said that, okay, you will pay to my accounts, to my suppliers, and you deposit the check to the you handed the check to the supplier, and supplier deposited to the bank. And the banking errors, bank is not like a guard. You can there may be some kind of error, so we have a possibility of banking errors as well. So your book side may not be recording the service charges from the bank side, interest revenue you earn from your accounts, and you write a check and you don't have enough money, so bank return the check. Your book side will not record that one. And cost of printing the checks, which is the services that banks provide, and also you can also make errors. You're not angel, you can make error. So that's why the bank side and book side, they made different in a normal circumstances. So in order to check that this is normal or abnormal, we make bank reconciliation. Okay, let's understand how we can construct bank reconciliation. There's the following illustration here. I just want you to pause the video and read the question by yourself, and at the end we solve it together. Okay, let's read the question together. So we have here the illustration, and it says the 30 the December 31st bank balance of Mid Atlantic Manufacturing is 5900. So this is 5900, the bank balance. The cash account of the company has a balance of $3,340. The additional information is here. as follows. We have deposit in transit, which means we have deposited a check and we await the money to come in our bank account. So that's why bank account is not showing the balance of 1600, but we already recorded this 1600 in our cash book. Okay, banking error. The bank deducted $100 for the check written by another company. So what is the solution here? We ask the bank to add back our $100, right? And the outstanding checks total $1,340. Outstanding checks means we write it down checks to the suppliers. So either they did not present it to the bank, or they keep it with themselves, or they transfer with someone else to receive the money. But these worth of check is not presented in the bank, so the banking account is not deducted with the outstanding check. Number fourth is ETF, electronic fund transfer, so which is not recorded in our cash books. So it is automatically received. We receive dividend on our investment 900, and then bank collected on our behalf $2,100. We authorize bank collection of your account receivable 2,100. So which means we don't know, we authorize our bank. So this is missing part in our cash book. This is also missing part in our cash book. Interest revenue earned on your bank balance, we just came to know through bank statement. So we will add it because this is revenue. We will add it in our cash book as well. And the book error that you made, the book you were supposed to record the check 150, but you recorded 510. It means the difference is 360. It means your cash book is overstated with this 360. Let me just read the number 7 again. That you recorded a check number 3334510. The amount you actually paid 150, right? So how to remove the effect, because you charge is greater, and how to remove the effect, you need to add back the difference. So that's why we add back the difference here. And the bank service charges was $20. How we know that? Because it is written in the bank statement, so we didn't record it since it's the payment. Charges are the payment, so we less the $20. 9 is net the non-sufficient funds checked from a customer, which means customer pay us a check, we add in our cash book, but it turned out to be a bogus check. How we can balance it out? We negative this amount from our cash book, that this was a bounce check. And number 10 is the EFT, electronic fund transfer payments of insurance 400. This is automatically deducted from your bank account. So how you came to know? Through your bank statement, and then you record it into your cash book. When you recorded this a payment, so you less it. So let's make a bank reconciliation statement. So I just want you to open the PPT and see the solution of bank reconciliation. So open this slide on PPT in a separate window and run this video as well. Okay, we know that. Let's talk about first the bank reconciliation statement. Let's talk about the cash balance as per bank statement. So our bank statement shows how much? 5,900. So all those balances or transactions that are not recorded into the bank statement, we add or less here in our bank statement section here. Let me just remove it. Okay, so we add deposit in transit. We deposited the check, but money yet to come. So on 31st December, because we deposit our check before 31st, so that's why deposit in transit is 1600, right? Okay, and then because bank wrongly charges this $100 to us, so we asked bank to add back. So that's why we are adding back this 100. And then outstanding check which are not presented in the bank, we write it down to our suppliers or to our, or for example employees whatsoever. So these are the outstanding checks, are the payments. We write it down, checks against payments, and they are not yet present, they will be presented. So in order to have a clear picture why we are lessing that one here, because we already less it in our cash book. Whenever we write down the check for payment, we already less it down. For example, we paid our suppliers, entry would be, we paid our suppliers worth of $340. What would be the entry? Accounts payable to cash, right? So we already recorded this entry, and less this entry or less this effect of the transaction from our books. So that's why we are lessing here to remove the impact of this payment. But due to the negligence or delayed or whatsoever reason, the supplier did not present this check to the bank, so that's why it is not deducted. So we just less here as well. So what is the balance here? Balance is $6,260, right? And now let's compare it with our cash balance per book. So what is the cash balance in our book right now? It is 3,340. So we add ETF revenues or receipts. So we received electronically 900. We didn't know until we received the bank statement. Okay, our bank is credited with 900. So we didn't record it in our cash book, so we recorded here, right? So we add it, and then bank collection of the account receivable on our behalf. We authorize bank to receive 2100 from our customer, so we are notified with the bank statement. Okay, 2100, and we did not record it into our bank. These are receipts, cash inflow, so that's why we are adding it. And then interest revenue we received in our bank balance $30. And then there's a correction, we wrongly added 150, 510. Instead we have to write it down 150. So our cash book is understated with 360, so we have to add it back this amount to remove the error. So that is why we are adding back this one, and less the service charges of $20 which we are notified with our bank statement. Okay, the bank charges you $20 for maintaining providing the services. And then the non-sufficient fund from a customer. So when we receive payment from the customer, what was the entry? We added down the cash to account receivable, $50 to $50. But since we did not receive this cash, we make a reverse entry. Reverse entry would be $50 and $50 to cancel this effect. In that case, this credit would cancel and this debit would cancel, right? In that case, that would be the non-sufficient fund, $50. The last one is the electronic payment that we have made as an insurance. We also write it down here, right? So all these 1 2 3 4 5 6 7, they are not recorded into a cash book, and we just when we just find out the net one, it is exactly equal. So it means your adjusted bank balance and your adjusted book balance is equal, so there is no chance of fraud.